once we've got properties we're looking at, we kind of know, okay, well, this is the goal we're trying to achieve. How do I know if it's a deal? And I'm going to break this down very simply. It sounds like an oversimplification, but it really is most of what folks need to know in order to identify a good deal. And what we do is we do a sniff test, right? So generally speaking, we're going to calculate in under 10 or 15 minutes the value of the property as it sits today. And that's simply current 12-month income minus current 12-month expenses. These are always not accurate, by the way, just especially if the expenses are coming from the seller or the broker. But we take it with a grain of salt. We do the math anyways. I already told your listeners that 33% is a rough rule of thumb. So if a property's bringing in 100K and they tell you there's 10K in expenses, it ain't right? There's going to be $30,000 to $35,000 in expenses for every $100,000 of revenue. But let's say that this property is generating 100 grand, and let's pretend that the seller tells us, and it cost me about 30K to run it. Well, we know that 100 minus 30 is $70,000. And we're simply going to multiply that, or I should more accurately say, we're going to divide it by the cap rate, right? And cap rate's a conversation that's probably a little deeper than we want to dive into today. I'm sure a lot of your listeners are well versed in that based on the quality of people you surround yourself with. But if anybody's not, it's a quick Google search away, and then running the numbers a couple times, because it can be a little convoluted. Long story short, right now, a very good rule of thumb, average 8 cap. So using a cap rate of 8 on a storage facility, I used to say 10, but those days are gone. And a lot of facilities are trading for 6 and 7 cap. So we're just using 8. I want your audience to take this with a big rule of, or a grain of salt. This is just a rule of thumb that we're using as an academic exercise. But so if we take $70,000 in net operating income and divide it by 0.08, I wish I had a calculator on me, but I can tell you that's probably 880,000, 850 to 900K, give or take, right? Because dividing by 0.08 is the same as by 12 and a half. So 70 times 12 and a half should be 875, if I'm right. Could be wrong. Nobody check me on that. Long story, but that's a long-winded way of saying, hey, we're going to run the numbers. That's the as-is value. If you could buy it at that number, that would be a fair price based on today's market. Now, that's not the price I'm willing to pay, because as an investor who's interested in adding value to their properties and creating equity that I can then convert to higher amounts of cash flow, I'm going to want to buy at a discount of some sort. Now, I might need to discount from that number, let's say 875, and say, hey, I can offer you 600 for the property and hope it works. But the more likely scenario is I'm going to pay them at or near the fair price based on the existing income. I might even pay them a little extra if and only if the next formula that I'm going to share with you pans out, right? So the next formula is the same exact formula I just described, except it's a projected income and expense. So this is where you have to get smart and look around the market and say, hey, listen, this lady's 100% full. That should be a red flag that she's probably not charging enough, because any facility that's over 90% occupied isn't charging enough in rent. We're also going to look at the competition and see how full they are. If they're all full as well, but they're charging more, well, it stands to reason that we can raise the rents at this subject property and get the rents up. And I'm not exaggerating when I tell you, I had one of my very first students bought a deal in Pennsylvania, and he literally bought it, paid full retail for it. And the day he took over, he doubled the rates. And like 10 people moved out. They knew how much of a deal they were getting, and he was still lower than other people in town. And so he quite literally doubled the value of the property almost overnight. Now, it took him 6 months to find the property, and it took him, then he had to own it at these new rates for a period of 6 to 12 months before an appraiser would come in and say, yeah, this wasn't a fluke, right? But the point being, our job as investors is to identify the value add opportunities within the facilities. And if we can identify them, we know it's a deal. And then it just becomes a matter of working with the seller to see if we can't get them the number they're looking for. Or if we can't, how close can we get to it? And what terms, if they're willing to hold seller financing, might allow us to pay them more than we otherwise could if we were going to bank, yada, yada, yada. I know that was really long-winded, Kyle. Hopefully it gives your listeners some insight into the game we're playing, though.